The entire financial system is unraveling. There's no way to stitch it back together. Way too much debt and slow growth are visible, which is absurd considering the historic levels of intervention. I hope the Fed has their printing press ready. You came here for the truth, so let me unveil that for you. Today we're going to look at Subprime 2.0. I want to show you a chart that has surpassed 1929 and so many other indicators. It'll make your head spin. Let's begin. The third most overvalued stock market. We have actually surpassed 1929 when it comes to the cyclically adjusted price to earnings ratio. This is also known as CAPE. Now, this is obviously developed by Schiller, a Yale economist, and this presents us with an indicator that I personally don't think matters very much, but the technical analysis, those who basically focus on technical analysis are always consistently paying attention to the CAPE. They look at it, PE ratios, and they use it for trading. They use it for their algorithms. So I do believe it is very important. I mean, I wrote about it in my first book. I do think it's important in the sense that they are looking at it. Not me. I don't judge a stock market to rise or fall based on this. I just point to it and say, look, they are seeing this too. That's all. Now, very quickly, I'm going to go through these two articles, just touch on a few points. A reversion to the mean in U.S. stocks could mean that the market will fall by at least 20%. That's according to David Rosenberg. All right. One of the strangest securities market rallies of all time, and that's because all asset classes have gone up, even ones that are inversely correlated. And that, my friends, is when you know that something is messed up. There's more in this article, but I need to move through quickly or else we're going to have another 20-minute video. Steve Eisman. You may remember him from a little book, a little movie. He famously predicted the collapse of subprime mortgages before the 2008 financial crisis, and he is now recommending shorting Deutsche Bank. Deutsche Bank is a problem bank, and they have profitability issues. They'll probably have to raise capital next year. Very big news coming out here because I've been showing you what's been happening with Deutsche Bank, and this is in terms of derivatives, potentially one of the biggest banks in the world. We're talking about enough on their balance sheets or off their balance sheets to destroy the entire world. So, no reason to worry. All right. I'm going to cover several charts here. Something I've touched on before, paying more for slower growth, historical bull markets. Take a look at over time we are getting slower and slower growth despite the fact that there has been more intervention. Real GDP 2.1. And we are supposed to be encountering the greatest boom in history. This is supposed to be the next roaring 20s, but real GDP is at 2.1. Just look at these other examples, 4.6, 3.8, 5.0, and so on. Previous time around was less than 3. And that's real GDP. Always factor in real GDP. Okay, next. What's every peak typically followed by? Well, I think that's quite self-explanatory. People have this feeling that everything's going to be okay. And they always think that right after it's too late. And then the market falls. Whether or not this will be one of those cases. I can't tell you that. But what I can say is that we seem to be entering the same exact pattern here again. My line is not exactly good, but you see where I'm going with that. The same patterns are always happening. What is this here? Household net worth, share of personal disposable income. A great indicator, actually, because I always have to think about how people are affected in their wallet. How does their money, their savings, the amount that they're spending, how is it actually, I want to know about it, basically. And not this whole, what is the consumer sentiment right now? Those aren't real indicators. I don't like that. I want to know what people are spending, what they're buying, how much debt they have, and so on. Okay? Fed tightening cycles and financial events. Something I've shown consistently, and this is denied over and over. I mean, it's silly. It really is. So the line that you're seeing here is the Fed funds rate, and you could see that over the years, clearly we know where it has gone. They have been inching up ever so slightly. But again, two things I want to mention. You can see that every single time the market cannot get to where it was before. The Fed funds rate cannot get to where it was before, as well as the fact that every time they try this, they encounter a recession. Okay, I have to say it. Every time I find a chart like this, I'm going to mention it. It's so important. It's so critical. Whenever somebody asks, what are you looking for? What are you looking for out there? I am looking for interest rates. Interest rates are the absolute catalyst. They will determine if the market will rise or the market will fall. The Federal Reserve existed here. Okay, the Federal Reserve existed here. The Federal Reserve existed here. But they were unable to stop it, or they didn't want to stop it, or they did it on purpose. Either way, every time the Federal Reserve raises interest rates, we have a recession afterwards. Gold is usually positive during recession, something that I thought this was quite interesting. I know there are many gold bugs out there, so I wanted to bring this to you. And you can see for yourself. During the time frames when times are tough, people are looking for safe havens. They're looking for somewhere to park their money. Even if it's for a temporary period of time, you will see that there are particular safe havens that tend to do well. That's a good thing. A lot of people are just dismissing one thing or another, not even necessarily gold. But there are periods of time where you need to move your money out, or the wisest investors will move their money around. And if you can do that, if you know how to do that, you can profit just astronomical levels higher than the average person just buying and holding. Moving on to subprime. Auto loan, 60 plus delinquency index. Well, we got a big problem. Since the financial crisis, we have seen a rise in subprime auto loans. The last time we saw this was leading up into the financial crisis. There was a deleveraging, and we have far, far surpassed these levels now. Prime doesn't seem to be an issue, right? But it's the subprime. And sure, auto loans, subprime, it's smaller than the housing mortgages. But all we need is a spark. We need a trigger. And this whole thing is coming tumbling down. Quickly now. Subprime securitization as a share of all auto ABS, asset-backed securities, subprime has surpassed its pre-crisis peak. So you'll see that here in the red. Just take a look at these levels, where it has gone. So here, this is 2007, and 2017, we've surpassed it. The average person doesn't know what's happening. The average person looking at financial data on a regular basis doesn't understand what's happening. But you and I, we clue into this information. I think it's so important. So important to look at. Well, I'm going to end the video there. I don't want it to go on too long. I hope that you enjoyed this. You found it informative. I'm trying to bring out as much good information as possible. This channel has really grown over the years, and just to know that people are still watching me after all these years and all of this information, they find it to be helpful. It's really so good to know, and it's something I think about a lot. So thank you all. And I just want to say that if you found it informative, please give me a thumbs up. And if you found this video informative, then I know you find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can flip through the books at Amazon. Links are in the description below. Take care. One point I wanted to make here, I have so many emails in my inbox. It's filled up to the gills. Okay, some people have been emailing me. They emailed me a second time saying, did you get my email? There are so many emails in there, and I'm not trying to stop people from emailing. I'm just telling you the delay is ridiculous right now. I have emails going back from March. I email everyone back. The only people I'm not emailing back anymore are those who are basically sending out bulk emails and trying to get me, to review a product or some ICO or whatever. I'm not doing it. Not doing any of that stuff. I delete those emails. I know you guys don't want to see that type of thing. The only time I'll do that is if it's something that I'm so excited about, and I'll probably be the one contacting them. But you know the way this channel works. That's all. I'll end it there. So what I wanted to say was, there's delay in the email, like huge delay, ridiculous delay, and I will reply to all of you. So that's all. Take care.